Welcome, everyone. We're going to wait a couple more seconds to see if a few more people join us this morning, or now officially this afternoon. I think in the interest of time, we'll get started, and I've enabled or disabled the waiting room so people can just pop right back in whenever they have the availability. So welcome, everyone. Thank you for joining us today in the first of our AIA Pittsburgh's Business of Architecture series. First up today is how to save money for retirement and plan the future that you want. With that, I always like to remind everyone, make sure that you have your accurate first and last name listed so that we can make sure you receive those very valuable CEUs for attending today's session. I see that you've all already done that, so that's great. And with that, I'm going to turn things over to our host, Santo. You can take it from here.
Thank you very much, Kira. My name is Santo Loporto. I'm a senior director and the relationship manager for the AIA Members Retirement Program here at Equitable. We've had this relationship with the AIA Trust for over 20 years. And, our intention around this program is to provide comprehensive retirement planning and distribution solutions to architects and to employees of architectural practices. So I'm really pleased to be sort of the first guinea pig in getting this Business of Architecture program up and running. I'm going to be presenting, sort of a basic overview of the retirement landscape and some information about demographics, particularly millennials, and then a little more about plan choice and the value of compounding and early savings. So I'll just launch in, and please, afterwards, I'm sure we'll have some time for Q&A. So learning objectives, you can see there, we're looking to understand how to calculate future needs for retirement and evaluate the market and demographic concerns, decisions around funding a retirement plan, understand the appropriate plan for one's business. Most of the plans these days are 401k of some version or another, but there are many other plan design choices out there that I can touch briefly on. And learn about the importance of retirement planning. And I'll show some statistics about where we are right now as far as the population in general on planning and saving towards retirement. So one of the first questions I usually put out is, what would you think was a top financial worry for most folks when they're surveyed about that? It's kind of a rhetorical question because I have the answer here. One of the top financial worries for Americans today is whether they'll have enough money towards retirement, and that's in advance of current bill payment, mortgages, or job stability. So it's and I think it's partly because of the ongoing information that the media presents about retirement planning and about retirement options, that there's heightened awareness about the need to adequately save for the future. Just some stats. 63% don't think their savings are on track. We're unsure. Pensions, and when we talk about pensions as sort of the traditional sense, where folks work for firms or practices and receive a pension from them to support their retirement years. That only accounts for about 22% of the marketplace right now. Most corporations, firms, and practices that had pensions have greatly scaled them back or eliminated them or converted them to cash balance accounts. And now we're focusing primarily on employee deferral plans such as 401k. Most generations are underestimating the risks and expense of retirement. And this is an opportunity for evaluation that folks usually start focusing on as they get closer to retirement, but trying to create a realistic list of what your financial obligations will be at retirement. One of the things that's usually underestimated is the cost of healthcare, medications, and other assistance around some of the unfortunate side effects of aging. 60% of college educated or higher work in I have that's a typo, I'm sorry. Have retirement plans. Every generation, however, needs to save more, and we'll talk a little bit about that as we move forward. So you'll see here some averages for retirement savings by demographic, by age. These are general savings by for the total population of the country, not architects in particular. I'm assuming that architects, those numbers are higher than the averages. You can see, as it would make sense, baby boomers have the highest estimated savings. Gen X's and millennials are lesser than those, just because of the horizon towards retirement planning. But you can see from these numbers that we're not really saving enough across any of these demographics, and we need to do a better job. A little bit about millennials. Born between 1980 and 1996, there's about 80 million individuals. It's the largest demographic now, bigger than baby boomers and other groups. And millennials will represent 75% of the workforce by 2035, so in about 14 years. It's important, and there's a lot of opportunity around millennials to begin saving towards retirement because of where they are in their age, there's a lot of opportunity for growing savings over time. 66.2% of working millennials have nothing saved for retirement. Only 5% are adequately saving. And 66% of millennials work for an employer that offers a plan, but only 34.3% participate in that plan. So they need to do a better job in concentrating on that. One of the main issues affecting some of those numbers are sort of the general trends for millennials, putting off obligations such as marriage and home ownership. This chart shows the change in adults 18 to 29 living with parents from 1970 to 2020. And as you can see there, it went from about 30% to up to 47%. So folks are staying home longer. And one of the main reasons for that is the effect of median net wealth and income ratios for these groups. You can see here for late boomers, Gen Xers, and millennials, millennials are well behind these other groups in the wealth to income ratio calculation. And the next slide will identify the main culprit here, which is student loans. Student loans are accounting for 40% of millennials have student loans on average. And if you look at the chart on the right, you'll see there that if you exclude student loans from net wealth to income ratio, the millennials fall in line with the rest of the population pretty well. Those numbers, that 40% number goes to 56, and all of the numbers go up as compared to that earlier chart that shows those discrepancies. So obviously, student loan management, paying down the loan and getting it in line with your finances is a key goal for this group. So again, there is good news. However, the fact that you have time to save as a millennial allows greater opportunity for compounding in a deferred environment, such as what retirement plans offer, to really make a benefit. This chart just shows what you'd have to save on a monthly basis in order to reach a $1 million balance at retirement. And 1 million right now is considered sort of the minimum that you want to have saved if you're a professional and trying to build a retirement savings. So you can see there, someone starting at 20 or 25 would be contributing between $361 and roughly $500 a month to achieve that goal, where someone who's starting at 45, that number turns into over $2,000 a month. So the earlier you can start, the more you can mitigate the need to try to catch up with larger savings contributions going forward. Some challenges, the marketplace has changed quite a bit. A few years back, as I mentioned earlier, pension plans were typical in the marketplace for retirement planning. Folks, pretty much professionals, began a career in one occupation, one job, and they stayed in that job through the course of their active employment. Folks now are considering different options, retiring early. Often folks retire early and look to start a secondary career or to try something different. Sort of the opposite end of that coin is delayed retirement. Folks might be sort of looking at, let's say you're 50, 55 years old, and you make an assessment of your retirement savings, add in Social Security, some other factors, and you say, well, I'm falling short. So instead of retiring at 60 or 62, as I had planned, I'm going to stretch that out to 68 or 70 years old. Working part-time in retirement. A lot of folks have also added this into how they're going to finance their retirement. If they haven't saved in an adequate way, they might be building in the idea that they will continue to work in some way or form during retirement to supplement income. So the lesson here, comfortable retirement requires some commitment and planning. The earlier you can begin planning on this, the better off you'll be. Some expectations and versus reality, some things to consider. Longevity. The great news is folks in general are living longer. One of the conditions that you have to think about is, well, do I have savings that will allow me to have a comfortable retirement for my longer life? And that's an important consideration. Back when Social Security first began, back in the 30s, I think retirement age was 65. Average mortality was maybe 68. So there wasn't a lot of years that you had to figure out for building retirement savings. The face of that has changed quite a bit in recent years, and it should hopefully continue to improve. Longevity should continue to improve, but it does require adequate savings for retirement. Inflation becomes more of an issue for the longer retirements, whether you're planning to retire early or living longer. The effects of inflation to erode your savings in real dollar terms and what your purchasing power is a risk, and something that you have to kind of calculate into what you need as a nest egg to retire with. The impact of taxation. So this is the, the decision on paying taxes up front and making post-tax investments, or even a Roth account, which pays taxes up front, and or deferring into a retirement plan such as a 401k. And the advantages of deferral are, one, reduces tax implications for the current year, and secondly, those monies grow in a tax deferred environment, and you pay nothing on them until you withdraw them. Because of that, the value of compounding in retirement plans is extraordinary, much more than the case in taxable investments. And now with some of the tax law changes that are being considered around capital gains and some other issues, the fact that you can defer these eventualities in a retirement plan are even more important. Market volatility and fluctuation. The retirement plans, through the mechanism of a 401k primarily, allow you to mitigate the issues around market volatility and fluctuations through periodic payment. And I'll talk a little bit more about that in a minute. So opportunities for architects. Why start a 401k plan or any plan? Save for retirement is obviously, the primary driver here. Now, just a word on plans. I know I've kind of focused on 401k plans because probably, over 95% of plans set up these days are 401k plans for new businesses or practices. However, there is an array of qualified plan choices and also non-qualified plan choices for retirement savings. Defined contribution plans, which 401k is one of, also includes defined contribution pension and profit sharing plans, which allow for higher total contributions than in a 401k alone. Many individuals, especially those who are, let's say, 50 plus and feel that they're behind the curve on their savings for retirement, might be also looking at things like defined benefit plans or cash balance plans. Both of those allow for much greater contributions to older employees to make up for lost time on the front end. So if you have the wherewithal to defer more money, there are plan types that will allow you to contribute 3 and 4 and 5 times as much as you could in a 401k plan. So all of those plan choices are available in the marketplace in general, and also available through our program with the AIA Trust. So obviously, one of the main drivers and benefits of a retirement plan is reducing your current taxable income, and anything you're contributing as a deferral for yourself directly reduces your income. And as a business owner or a practice owner, contributions that you make for employees also can net out of practice expense and business expense. And of course, these are putting on your practice owner hat. If you are a practice owner, these are benefits for your employees that work to retain valuable employees. And if folks are looking for opportunities in architectural firms, the availability of a 401k or a retirement plan in your practice might be a differentiator for you, and it'll increase the quality of the applicant you'll get. Opportunities for architects on saving for retirement. Obviously, you're building a nest egg to supplement Social Security, as well as proceeds from the sale of your business or practice and other investments. We've already talked a little bit about the changing landscape and with some tax law changes that might be coming down the pike in the next few years. And that may or may not have an impact on some of the proceeds from the sale of a practice or a business or a building. Also on capital gain implications for taxable investments, other investments that are not in a deferred account. So really important to try to build assets in a product and in a program that's designed towards retirement planning, such as one of the retirement plan options like a 401k. One of the things I alluded to earlier was the benefit through 401ks for averaging out risk. And 401ks typically allow for usually twice a month for employees to make deferrals into the plan. What that does is automatically incorporate a concept called dollar cost averaging. And dollar cost averaging is simply buying in to an investment during sort of even increments over time at even dollar amounts. And what that does for you is if the market's rising and prices of whatever you're investing in are going up, you're buying less shares, so you're sort of reducing your risk on the upside. And then if the market comes down and those prices are dropping, you're buying more shares at a lower price. And over time, that type of sell short on the upside and double down sort of on the downside, increase or mitigate market fluctuation, negatives from market fluctuation, and give you the best opportunity to continue a secure investment strategy in a particular asset class. We've already mentioned it a few times. I'll just say it again since it's here. Compounding interest can work against you in things like student loans and borrowing, but they really compound interest, especially in a deferred account like a retirement plan, really makes a big difference in your ability to build assets over time. Excuse me. So just another example on that point, looking at folks in age categories 25, 35, and 45 with the same periodic monthly investment into a retirement plan. And you can see there the 25-year-old, 1.4 million and projected value at 65, and the 45-year-old, 333,000. So quite a big difference. And that's the value of compounding over time. So talk a little bit about the plan choice that you'd make to maximize your retirement savings. And by the way, if you're a practice owner, we could work with you to determine which plan type or combination of plans can give you the maximum benefit towards your retirement plan and also support your contribution and support of your employees. But on the investment side, there are a few tools that we use to help with the performance of your retirement plan. One would be offering target date allocation portfolios. So these are a one-choice strategy that you align with your retirement time horizon. So you would set up, let's say you're a moderate investor, so you would set up a target date, well, you buy into a target date moderate income fund that was a 2040 fund. So what that would mean is that portfolio would maintain a moderate footprint in that asset class space for the whole time period between right now and 2040. But what it would also do is decrease risk over time during those years, because the assumption is as you're getting closer to 2040, you're getting closer to your retirement age, and you'd want to mitigate risk a little bit in that general asset class and investment profile. So that's how target dates work. Allocation portfolios, and again, we're talking about our program, but these are available broadly in the marketplace. Allocation portfolios are similar to target date funds, but they do not have the decrease in risk feature. You just buy allocation funds based on their investment segment and their risk tolerance level, and it's up to you to kind of ratchet those up or down as you get nearer to retirement. And then the third type, which is sort of open architecture, you choose your own investments, you choose from a multiple of investment classes, and you build a strategy to finance your retirement through your plan. Normally, folks that pick this option are working with a financial professional or financial consultant that helps them in some of those decisions around managing their accounts. And we also offer services around those needs as well. So if you need someone to talk to about your investment decisions and how you're allocated in your plan now or in your investments in general, we can help with those needs as well. Again, some benefits around these programs for architects. In 2021, contributions in a 401k can be made up to $19,500 annually. And there is a catch-up provision for folks who are 50 years or older that gets you to 26,000. Now, as I mentioned before, if you just go for a defined contribution plan, let's say something like a profit sharing plan, in addition to the 401k, those numbers go up to $58,000 and $64,500 with the catch-up provision. So quite a bit more saving potential if you needed it, if you modify your plan choice, your plan decisions. You also get a deduction on contributions that you make to eligible employees. And again, these contributions grow tax deferred until they were withdrawn. So you get the maximum benefit of compounding. Benefits for employees: if you're owners of the practice, you put your owner cap on. Offering this plan can help in hiring qualified employees and retention of valuable employees as well. And this includes other architects that you might be hiring into the practice that one day might be looking to purchase it from you or to help you grow it. What are the costs? Costs for these programs run through, for our program, run through administrative fees and program costs. They are mostly asset-based costs. Most of the marketplace right now is either in asset-based or fee-for-service, depending on the plan type that you have and your assets under management. This is a main consideration for most individuals when they're choosing a plan and a provider. Typically, as plan assets grow, you would gravitate more towards a fee for service environment where there is not as a great asset-based charge, because obviously even small basis point charges can add up in very large accounts. So we can assist you in identifying how those fees line up, and both in our program and just in general, if you need some information for your own, if you have a current plan right now with someone else. Our program also, all the investments in it are, there's no back-end charges, no front-end sales fees, and also any third-party investments that we offer, if those investments have minimums, all those minimums are waived for 401k contribution. As I mentioned a few times, our program is endorsed by the AIA Trust for more than 25 years. And Equitable itself, over 160 years that the company has been around, more than $220 billion in assets under management, over 2.8 million clients. Obviously, that's the whole company, not just this retirement program. And then finally, why the AIA Members Retirement Program. We're designed to deliver an affordably cost basis turnkey program. It's a full service master plan. We do all the record-keeping administration, wide range of services, and we minimize the time you need to manage these programs, and you can spend more time doing what you do for a living day to day. So that's the basic points that I wanted to make today in this presentation. Here's some information on how to contact us. If you have questions or any interest in our program, or frankly, even if you just have questions about your current plan or retirement plans in general. One of the things about our relationship with the AIA and the AIA Trust is that we're trying to look at it in a holistic way, that even in cases where we're providing information or support for an individual who's not invested with us, we feel that it's helping the community in general, the architectural community in general, and moving things forward for the organization. So we're happy to do that as well, be a sounding board if you need information or want to fact check anything that you might be hearing or understanding from another provider. So with that, I'll stop talking, and if there are any questions, I'm happy to address them.
Hi, Santo. There are a few questions in the chat. I can read the first one off for you.
Sure.
It says, if you plan to retire in a country with higher taxation, you should probably choose a Roth option pre-taxed so that you would not get hit later, correct?
Correct. Taxes, if you think that, excuse me, if you think that taxes are going to be higher in the next X years to whenever your retirement horizon is than they are currently, then a Roth option is a good solution. And I only touched on it briefly during the presentation, but just about all of those defined contribution options that I spoke about before are, especially the 401k options, are offered as Roth.
And there's another question that states, if you are a small business, LLC, S Corp, is it still convenient to have a 401k or is a Roth IRA better?
So the difference basically is the contribution thresholds. For an IRA, I believe there were about 13,000. And you saw in the example for 401k over 19,000. For a small business owner in a program like this, I can only speak for our own program. It's a full service master plan, so we do all the administration and record keeping. We do all the tax. The one difference between an IRA and a qualified plan is the tax reporting. There is a required form that's submitted to the Department of Labor every year, which is a 5500 form. In our program, we complete that form for you and we send it to you electronically. And we also send it to the Department of Labor electronically for filing. And all the plan sponsor or owner would have to do is log into the DOL website and approve the document. So, but we often find that when we do comparisons for folks, that the qualified plan makes more sense in a contribution percentage and than an IRA.
Those are the only questions in the chat.
Okay.
I think that we have a small enough of a group, though, that I would encourage anyone to, if you feel comfortable, please unmute yourself and you can ask the question live, or if you'd prefer not to, please, direct the message to me and I can read it for you.
Yeah, I'll just add, I don't think it's listed here, but if you look at the first email option there that says mrp.marketing@equitable.com, if you put in Santo, SANTO .Loporto, LOPORTO @equitable.com, any question or inquiry you have will come directly to me, to my email, my personal email, and I'd be happy to follow up with you.
There is one more in here from Michelle Fonzo, our Executive Director of AIA Pittsburgh. She wants to know, how are the assets you manage invested? I ask because with AIA's emphasis on sustainability and equity, I wonder if you invest in ESG, economic social governance, or other types of sustainable funds.
Yes, we do. And in fact, Equitable has recently gotten much broader in that area as far as how we're running all the assets that we control for clients. And ESG has become a significant milestone for us to achieve. The program as it exists right now does offer appropriate investments in that category. And we're looking to get even deeper in that as we go forward. It's become one of the cornerstones of our corporate mission statement.
Great, thank you. Does anyone else have any questions for Santo?
Okay.
I think everyone's really shy today.
No problem. Well, it's been a pleasure. As I said, if you do have anything that comes to your mind after we sign off here, I'm happy to provide any assistance I can. And if you want to just go through Kira, through the Pittsburgh AIA, she has a way of getting in touch with me as well, and we can handle it that way as well.
We can absolutely connect anyone with you if there's interest. I'll do one last call for questions. Okay.
All right.
Well, thank you very much for joining us today and sharing your expertise. We really appreciate it.
No problem. I hope I was helpful.
Absolutely were. Thank you so much.
Thanks. Bye-bye.
Thank you.
Thank you.